my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel, zinc and tin. LME 3-month nickel. After the big break lower, when the two pitchforks split this market back in October last year, we had seen some deviations lower to make a small sideways triangle, for example, over November and December last year, but overall prices had tracked sideways until 7 weeks ago. To discuss this, we must look back 16 weeks ago, when I said about the sideways movement of the market, and I quote, "I suspect this seeming sideways movement may not last, as coming in from above, we have the declining short-medium moving average, currently at 17,065, which may well apply pressure on prices and cause an action or a reaction." End of quote. Remember that short-medium moving average. It is highlighted in green on my daily chart, and it will crop up again later. Anyway, in mid-February, we did have a reaction as the green highlighted short-medium moving average saw the market break above it, through the now flatlining medium moving average, currently 16,825, almost as if it wasn't there. Indeed, prices used the medium moving average highlighted in mauve on my daily chart, along with the June 2021 low at 17,095, as a base of support for another move higher in late February, through the October 2019 high at 17,815, through the July 2022 high at 18,265, but peaking 4 weeks ago just under the gold highlighted declining long moving average, currently at 18,330. Prices have then pulled back, but have started to find a base again at the May 2021 high at 16,610, and around the combination of the short medium moving average and medium moving averages. Now, I've been contemplating what sort of pattern the market's creating. I said 4 weeks ago, and I quote, "My initial thoughts 2 weeks ago," so it's now 6 weeks ago, "my initial thoughts 2 weeks ago were to look at the early November 2023 action, to-date action, as a possible rounded bottom pattern. But the more I look at it, the less I like it. Instead, I'm inclined to look at the whole early August 2023 to date action as a possible descending scallop pattern. This has merit, but it is very elongated, and that is a negative point. The main thing in its favour is a new pattern I suggested might be created 2 weeks ago. Again, this is now 6 weeks ago, and which we have indeed completed, and that is a monthly key reversal up by some considerable distance. Thus, I am now looking for where the hesitation will be for such a pattern on the top side." End of quote. So I was ready to look at hesitation in this market 4 weeks ago, and guess what happened? We had hesitation 4 weeks ago, and prices dropped back down. Okay, I said 2 weeks ago, and I quote, "This hesitation could mean we see a test down to the lows seen in February and November 2023, down in the 16,000 to 15,850 zone, and from there we could see potential targets for the descending scallop pattern." End of quote. Well, we were stopped short of the 16,000 to 15,850 zone 2 weeks ago, which doesn't make it impossible, but sure does make it difficult. I said on this move back up last week, and I quote, "It now depends on whether prices try back up or go the distance lower, as these next few days could determine what the greater pattern will be." End of quote. So, since last week, prices have started to gradually move higher, overcoming the October 2019 high at 17,815, and interestingly the middle time currently at 17,650 of the old, broken June to August 2022 bearish shift pitchfork, and approaching the one true resistance that has so far capped the market in recent days, the long moving average. What does it mean when it reaches this moving average will likely determine what will happen for the next few weeks, and maybe even months. The only caveat to this is maybe, just maybe, it wasn't the long moving average, it was the June 2021 high at 18,610 that back then was close to the long moving average that may have been the driving force in capping the market in March. At this point, I'll have to wait and see. LME 3-month zinc. The big picture here continues to be based very much on actions originating from last year, with some limited skewing, I suppose, and recently a bit of a battle happening, which seems to have been won and lost by the respective sides. You see, as I've said over many weeks here, we've had two competing shift pitchforks here. We have a recent late May to mid-August 2023 mildly bullish shift pitchfork, which is highlighted in bright red on my daily chart. The market at the moment between the upper time above, currently at 27.33, the middle time below, currently 25.69. It's closer to the upper time. The second shift pitchfork, the larger, very large, May to August 2022, that's right, a pattern that is a year and a half old. The May to August 2022 bearish shift pitchfork, which is highlighted in purple on my daily chart. In this one, and it's a very important thing to note, in this one, prices finally punched up and out of this pattern in a final flurry last week over the now broken and venerable upper time, currently at 24.61. This has been the rub of the market. I said 6 weeks ago, and I quote, the upper time of the larger purple highlighted bearish shift pitchfork was now well within the smaller bright red bullish pitchfork. Indeed, they cross over on the unusual 29th of February this year. End of quote. I further added, and I quote, I would now like to emphasize once again how this bearish shift pitchfork, which is now well over a year and a half old, I wish to emphasize how it is still working in the overall bigger picture to drive prices lower despite some move upwards during 2023, including the monthly key reversal like we saw in December last year. One way or another, the times are being tested here. The question is whether the bright red bullish shift pitchfork will give way and we see prices move down through the lower time again, or will the bigger purple upper time give way? We have a whole new potential outlook on this market. End of quote. Well, it took a little longer than anticipated, but the break higher up and out of the purple bearish shift pitchfork was finally adequately sustained. We are now well within the bright red mildly bullish shift pitchfork. Indeed, the move higher has been enough, bearing in mind my thoughts that neither the purple or red pitchfork would come away from this battle unscathed. Anyway, the move higher has been enough that I have drawn a small early February to late March bullish Andrews pitchfork on my daily chart. It is unhighlighted at the moment, but we are within or in between the middle time below, currently at 26.09, and the upper time above, currently at 27.48. I'll be very interested to see if this new bullish pitchfork stands up to the rigors of this market, or if the upper red time caps the market as it has done in the past. As a final postscript, I note the possibility of a golden cross of the rising short medium moving average, currently 24.79, moving up over the rising long moving average, currently 24.80. LME 3-month tin. There were, in the recent past, multiple major patterns, still visible here, acting on this daily chart. This year's actions has seen the market push back up from the stratified congestion bands below, over all the moving averages, up to the highs not seen since July last year. This emergence led me to start with a just barely possible pattern here, a mid-October 2023 to late January 2024 inverted head and shoulders pattern, with a dark blue highlighted neckline, currently at 26.725. I laid out 9 weeks ago target topside for this pattern, and they have all been reached. This brings me to another pattern, and one related to this reverse head and shoulders, and that is a mid-October 2023 to very early April 2024 ascending wedge pattern. You can see this highlighted by two trend lines. The lower trend line, currently at 26.865, is highlighted in bright red and supported by the rising short medium moving average, currently 27.090, and the previously mentioned dark blue neckline, currently 26.725. And before you ask it, yes, we've passed the apex last week. Now, this ascending wedge pattern, along with the reverse head and shoulders pattern, gave some additional potential targets above, with a primary target in the 28.360 area and a secondary hard to reach target X3 up there in the 29.600 area. The primary target was achieved earlier, and I'm pleased to note that this week the hardest to reach secondary target X3 has been achieved. Okay, so there is a further final pattern that's being challenged, and it's being done today. I said weeks ago, and I quote, "You see, it seems the ascending triangle pattern has morphed into another pattern, this time into a bull channel, a late December 2023 to date bull channel, currently 26,865 to 29,785. To help aid in seeing this pattern, I've highlighted the upper bull channel line, also in bright red, same as the lower bull channel line. I said 6 weeks ago, and I quote, "Of all the patterns, I think this is the one to pay close attention to, as it's still fairly young compared to the others, but is also the most potent," end of quote. What had been extraordinary has been the influence of the upper bull channel line on this market. Not only had it capped prices all this year, apart from today, but has caused the market to fall off a cliff 3 weeks ago. The move lower was so violent that I mentioned it when it happened that we were a good way towards making a possible weekly key reversal down. However, in the end, prices tempered the move and we ended up with a lesser outside weak pattern 3 weeks ago. Since then, we have seen consolidation based on congestion at 27,330. But I suspect more important was the 50% Fibonacci line for 2023 that is just below that at 27,155. And a gapping move higher that's pushed up clear and in all likelihood broken this bull channel on the upside. It's still only today's action that matters, so I'll wait to see if the market exploits, consolidates, or even foregoes the move higher. But I would start thinking about a possible potential for this break higher, up in the 32,700 area, just above the 50% Fibonacci line of the March 2020 to March 2022 move, up there at 31,845. Finally, as I speak, prices they have filled in the gap left over from January 2023 between 30,655 to 30,700 and are continuing on their way higher. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.